Okay, so thank you, Janelle,
Absolutely.
for sitting down with me and answering questions pertaining to the real estate industry and the pre-approval process, mortgages. You do refis, right,
Yep,
as
absolutely.
well? So really the whole point of this conversation is to really enlighten the general customer, right? Not everyone buys a house every single day, but you and I go through those experiences.
Right, we live it every day, so it's
We
easy
live it
for
every
us,
day. So I really just want to shed some light on what it is you do specifically in the industry and how our businesses collide. And
Okay.
actually, we just wrapped up a pretty challenging I mean, they're all challenging. They all come with their
own little quirks
yes,
and hurdles.
yes, to say lightly,
Fires.
right? So I mean, we really did just wrap up a really challenging deal for first-time home buyers, and it really takes a village in what we
Absolutely.
do. And it had not been for you and your expertise and your team here, as well as our escrow team, I mean, really would still be
We'd
sitting
still be
around.
trying to get it funded, and that's
Right.
really one thing a huge takeaway is to realize that you're not just working with the real estate agent. That real estate agent has secured for you a team of people that are going to get you from point A to point B, and that's a really important thing to have when you're making this big of an investment, and when you're, because there's a lot of fear there, and there's a lot of stress there, and you really want to make sure that you do have a team that's going to hold your hand and get you right through that finish line.
Right. So speaking of which, what is it that, what is a normal conversation when clients come to you, maybe a first-time home buyer, never been through the process before, tons of questions, right?
Well, typically, you'll be out working an open house, and somebody will come into that open house and express an interest in buying, and you'll say, call my lender. That's always the first thing you need to do, is secure your financing. And it may not be the financing that you ultimately get, but at the very least, it's going to put you on a really good path to know what you qualify for and what you should be out in the market looking for. There's nothing worse than falling in love with a house and then later trying to wrap up your financing and finding out you don't qualify for it.
Definitely.
So the very first thing I'm going to do is I'm going to ask you for some income documentation. Typically, I take 2 years tax returns, W-2s, a month of pay stubs, 2 months of bank statements, and I am going to want to run your credit. What that's going to tell me is exactly what you qualify for, exactly what you should be looking for. And if you go and flex between a single family home and a condo, I'm going to be able to tell you what that condo price is going to be, including the HOA dues, which is also going to be which is also important to know. We're going to talk about rates. We're going to talk about payments. You're going to give me an idea of where you want your payment to be, and I'm going to do my best to make sure that that's where your payment lands. I'm going to explain to you what taxes and insurance and an impound account means, and what that means for you going into your mortgage. And I'm also going to talk to you about investment opportunities and how you can look at this purchase as an investment opportunity and what that's going to mean for you 5 years, 10 years down the road.
Right. Okay, great. So you touched on a couple of things there that make a really good point. So let's say you are not pre-approved, but you really want to buy a house. So you go out and you take a look at properties. You're at open houses. There's a huge misconception that, okay, cool, I pay $2,200 a month in rent. I can totally afford a mortgage based on that payment. But in sitting down and actually going through the numbers and debt to income ratio and everything else that's involved, I mean, you can afford $2,200 a month in rent that you're currently paying, but does that really equate to a mortgage for that amount?
Right. And it does not all the time. However, you will find that a lot of times you might be paying $2,200 a month in rent, but we could get you into a mortgage for either less than that or with the tax benefits to bring you down to something that's less than that.
Right. So when working with you and really, crunching out the numbers, understanding affordability, so let's say you're looking at homes in a certain price range. I always recommend to my clients, don't be so set on the price. You know, it's a very competitive market, it's really strong sellers market still. There's just not enough inventory for as many buyers as there are out there that are qualified and ready and willing to buy. We just don't have as many homes to sell them. Unfortunately. So, you know, the multiple offer situations, things like this where, you know, working with Janelle can give you a better sense of confidence going into if you had to increase your offer price, right? Like we're working on with clients right now in the same situation. But really don't get so hard set on what the price is that you're paying. Your appraisal is going to kind of be a safety net, right? You don't overspend or get in over your head what you can't afford, or, you know, overpaying for a home unless you want to. But it's really about the monthly affordability, right?
Which is interest rate.
Right. So speaking of interest rate, you had mentioned to me something that's happening in the market that not everyone is really talking about. So
and that's interest rates. Interest rates are going up. It's pandemonium. Well, and the fact of the matter is that what Marlena was saying about affordability is absolutely right. And your interest rate has so much to do with that. So we have so many little strategic ways to get your payment down, get that rate down, and there's a lot of give and take with down payment and also buying down your rate, which is also known as points. Now, points have been such a demon in the market. Don't pay points, don't pay points. Well, understand what points are before you say and deem them to be evil, because they're not always evil, and they are going to be determined by that day's pricing. So sometimes it's 3/4 of a point, sometimes it's 1/8 of a point, sometimes it's 1/4 of a point. But there are different variations to buying down your rate, to making your payment more affordable, that is also going to be affordable to you. And the one thing that you have to remember in that is that it's your choice. A lot of lenders will throw out a rate and throw out the cost to that rate, but what they're not telling you is that you have a choice. You have a choice to maybe pay a little bit of a higher rate and much lower cost, or you have the ability to get a lower rate, and you're going to have some costs, but at the very least you decide and you have control over where you want that payment to be. One thing that my clients can attest to, that when they come in to visit me, I turn my computer around and I show them the rate sheet and I say, this is the rates for your scenario. Where do you want to be? And they'll choose a rate, and I will explain to them the cost or the credit that coincides with that rate and why that is. But touching on rates and why rates are going up, so I'm gonna try to make this as quick as possible because it's a long process. But nobody's talking about this right now. People are saying, oh, our economy is booming. Oh, people are going back to work, and that's why rates are going up. That is a very, very small reason why rates are going up. Not only is it a small reason why rates are going up, but it's also a very small reason why we get any kind of market flux of rates going back down. The influxes right now are very, very small. What you need to remember is that interest rates are going up, and it's kind of like a locomotive. It's not going to stop. They aren't going to jump up to 10%, but they are going up. They're still very much historically low, but they are going up, and here's why. Not so recently, we've all kind of overcome this and gotten past it, but when the market crashed after 9/11, that was a very changing day in our country, and our market crashed, and with it several other markets behind it. I mean, I'm in the mortgage industry and my husband's a contractor, so it wasn't 6 months before he started feeling the stress of my market, the real estate market really going and crashing. So what our federal government did was they funneled not billions, but trillions of dollars into our bond market. So a really good way to gauge where interest rates are going to be is look at what the stock market's doing. When the stock market's down, investors will yank their money out of the stock and they put it into the bond, into the treasury. Okay, when the bond is strong, interest rates go down. Okay, when the stock market recovers, they pull that money right back out of the bond, they throw it back into the stock market. The bond is like a very slow growing, kind of a holding tank for funds. So that it minimizes your losses, basically. So if you're an investor, putting money into the bond will minimize your losses. So When that money is taken out of the bond and put back into the market, you'll see interest rates go back up. Well, our federal government, to bail us out of this major crash in our economy, they started funneling trillions of dollars into the bond. What that did is it artificially lowered interest rates. If you've ever heard that term, our interest rates are artificially low, that's what that means. It means that money that would have normally not gone to the bond did, and that forced our rates down. Well, that was a bailout, and what that did was it allowed people to buy. It made money so cheap that people that couldn't afford a $400,000 home could all of a sudden afford a $400,000 home because it was priced at 3.5%,
Right.
and that got them into that rate, or that got them into that home. That's great. Real estate market boomed, lending market boomed. We've recovered from the crash.
Right.
It's all good. People are getting back to work. Our economy is now the strongest it's been in many years.
Right.
So because of that trillion some odd dollars that went in, that created a deficit. So what has to be paid? What has to happen? We got to pay it back.
Wow.
So starting in April, and this is right when, not April, I'm sorry, we're coming into April. Starting in February, the Fed announced that they are going to start pulling money out of the bond. Okay, they're still putting money in. They're just going to pull $4 billion back at a time.
Wow.
Okay, so this last influx of funds that went into the bond was about $24 billion. Wow. Okay, instead of $24 billion, they put in 20. They pulled $4 billion back. That $4 billion goes to repay our enormous deficit of what we originally put in. Interest rates.
And that's when they
Interest rates went up. Yeah.
Just the beginning
That's
of the year.
That's going to happen again in April. It's going to happen again for the next couple months.
Right.
Okay. And over the next 4 to 5 years, I want to say, we're 2018. So I want to say we should be at zero in the year 2025 to where the Fed's not putting any money in. They're going to pull it back $4 billion at a time, a few $1 billion here, a few $1 billion there at a time, which naturally is going to make the interest rates go up. We are forecasting that rates should be 4.5% to maybe 5% this year at some point. And I know that freaks everybody out, but I got to tell you, that is still a historically low rate.
Yes.
Very low. That is still very cheap money. It's still a great time to buy, considering the fact that they're also forecasting home prices to accrue value at the rate of 5% a year, which I think is actually a little aggressive. Okay, because California is this beautiful state of pockets. Okay, so you've got a Newport Beach pocket, you've got a Rossmore pocket. I'm right down the street from Rossmore, so I know that pocket very well. You've got LA pockets, you've got all these different pockets, and so one pocket might accrue value at 6%, one might accrue value at 2%. They averaged that out, they got to 5%. But I'm even talking to my clients about a 4%. Even if you look at a 4% increase in the value of your home, you are making a lot of money on that home. California is still a great place to own property. Yes, it's a little bit more expensive, but a lot of people that are bailing out and they're going to Idaho, or they're going to Texas, or they're going to Arizona, other states where they can buy property a lot less. Those properties are accruing value at maybe 1.5% to 2%. So it's all really relative.
It is.
To what you're going to get in the state of California. So California is still a great place to own property. But that's why interest rates are going up, and that's why people who are waiting to buy, they think, oh, I'm going to wait for the next fallout. There's not going to be a next fallout.
Exactly.
There's not going to be a next fallout because the federal government right now controls all of that. The only way for us to recoup that $4 billion that's being taken out is for private and foreign investors to come in and put in $4 billion. And right now, we don't live in an environment where foreign investors are really loving our bonds. So that's so that's really why nobody's talking about it. So that is information that you are giving your clients that is so valuable to know. So if you are on the fence, that's okay. No, you'll still be able to borrow money inexpensively, but right now you can borrow money at 4%. At the end of the year, it might be 5%. And that's going to make a big difference in the affordability. That could make the difference of you owning a $500,000 house and a $550,000 house.
Definitely.
Easily. Yeah.
Yep. So Are there any questions or, just your typical conversation every day, because you do this day in and day out, you've done it for 20 years. What is the biggest misconception that you see with, clients who come in looking to get pre-approved?
Clients who come in and say that they already went online and looked at rates and are thinking that the rate that I quote them is going to be comparable to what they see online. The difference there is they based their information off what a computer told them versus a person with 20 years in the industry who's looking at their stuff, who says this is a closable loan and this is what it'll close at. And having that kind of service, that warm touch, that phone call that gets answered on a Saturday versus that computer who spits out a rate that is not even in the realm of being something that they'll probably get. Those rates online are designed to get people to call in. That's really, it's a marketing technique.
It's a hook.
It's a hook. It really is. And people get hooked, and then we get the phone calls 2 weeks later when it's like, hey, we're already 2 weeks into our escrow and they're not getting what they were told. Can you close it in 2 weeks? And we get those calls a lot. Yeah. Sometimes we're able to close them in 2 weeks, but not all the time. So the bottom line, even if we can close it in 2 weeks, it is a very stressful transaction for everyone involved. So sit down with a mortgage lender and talk to them about what is realistic and what's not realistic.
Right.
Yeah.
Okay, awesome. So, with that, I have heard from, just in passing, I've really been selling real estate full time for like almost 5 years. It'll be 5 years this summer. And so, just family, friends, people I come across, it's like, yeah, houses have gone up, prices are so high, I don't think I can ever buy. And it's like, well, have you tried? Have you spoken to the professional who can give you that guidance and let you know if you can or not? And so it's like, oh, well, my credit's not that good and I have student loan debt, or, we short sold our house a couple years ago.
We don't have 20% down.
We don't have 20% down. Like, how much down do you need? Does a buyer need?
We have programs. We are just now getting guidelines on programs that will actually allow for 100% financing again. But they're niche programs. They carry higher rates with them. And we still have to make sure that the buyer qualifies and is able to repay the loan.
That's kind of important.
That's very important. Yeah, that's a mistake that they made 8-9 years ago. We won't make that mistake again. They're good quality loans, good quality financing. They're really designed, like a lot of the no income, no asset stuff that's starting to hit the market again is designed for self-employed people. We have bank statement loans. So if you're self-employed and you write everything off, we will qualify you based on your bank statements.
Cool.
It's a great program. Again, these nichier programs that aren't your cookie cutter 20% down conforming loans, where you'll qualify for them, but where you pay is rate. So don't expect to get quoted 4.5% for something like that. But these options are designed to get you into a property, give you maybe a 5 to 7 year term so that you can get your books in order and then be able to refinance out of that rate into a conforming rate, fixed rate, never have to touch it again type of a situation. So we have 5% loans, we have 3% loans, we have FHA, which is 3.5%, we have VA, which is 100%. We have every kind of different way
situation,
of getting people into homes. Honestly, I think what's keeping people from buying homes is the fear of buying homes, because the loans are out there, the programs are out there, the help is out there, the down payment assistance is out there. We are licensed in all of the CalHFA down payment assistance programs.
Very cool.
And one thing, those are great programs. There is no doubt. They're great programs. They're for a certain buyer though. So I have actually sat down with people who came in wanting that CalHFA. I want that CalHFA loan. I want that 3.5% grant. I want that free money. That free money isn't always free. And I've actually converted them into like an FHA loan, because they had some money And they wanted to spend somebody else's money, which who wouldn't? I would want to do that too.
Yeah.
But what I did was I talked to them about what it was actually going to cost them down the line. And it was going to cost them a lot more than the 3.5% down payment that they ended up coming in. It was a lot. It was a lower rate. It was better financing. And so that's really what I'm going to do is I'm going to sit down and I'm going to look at everything in front of me and I'm going to say, here are your choices, but this is your best course of action. In my opinion, this is the loan I would take if I were buying this house. So.
Awesome. Well, with that, we'll wrap it up.
Okay.
But I really just want to impress upon everyone who you work with matters. Like you said, people jump online and they take that information for face value, and it's really most likely not the case. So if you have questions, considering getting into the market and buying, whether it's your first home, another home, an investment property, know your options, know what you're actually capable of, what situations, could be out there for you. Janelle, she's amazing. Sunday morning, she's answering my phone calls and emailing me back. We work, our businesses, we really could be on call 24/7.
Yeah, they don't stop. And most real estate business happens over the weekend. So,
right.
I mean, that's just, that just is what it is. You kind of know getting into this industry what you're getting into, but also having a real estate agent that is going to put the right people in your path to make sure that transaction is successful is, it's priceless. So we make a good team.
Yes.
I think we make a really good team.
Yes. Thank you so much for your time.
Thanks for having
your
me.
knowledge and everything else you do for me and my clients.
Yeah.
We met very just coincidentally. I didn't go seek you out or anything
Actually,
like that.
you were forced to use me.
I was.
You were forced to use me because I happen to have been the only lender that could lend in that complex.
Right.
And we hit it off, and we realized, I think we realized that we made a good team, and here we are. So it's been it was an awesome change for me, and I hope it was for you too.
Totally. We didn't
nothing
even,
like being forced to use
yeah,
it.
and we didn't even work on that deal together.
No,
but
no, we ended up closing him somewhere else.
Yeah,
didn't we?
you impressed me so much. This lady works as hard as I do. So I've continued to refer Janelle to all of my clients, if nothing else, even just to get more information. You don't have to, get pre-approved, but if you can offer the guidance and assistance,
absolutely,
then what else,
Yeah.
That's what you need.
Yeah.
So thank you so much.
Yeah, you're welcome.
I look forward to doing tons more business with you.
2018.
Yes. So if you guys have any further questions about real estate, getting into the market, buying a home, mortgage questions, what can you afford, want to talk rates more with the expert, then leave us a comment, send us a message. We'll get back to you guys. We would love to help you out. See you later. Bye.